Hi, this is Al Costanzo, President of Costanzo Financial Advisors, a premier financial planning firm. I'm really excited for this video today as I'm going to be going over what exactly is happening in today's market. And my hope is through this video, you'll get an understanding of what my firm's values are. You'll get an idea and education on what is actually going on in today's market. And you'll also get a good idea on what my firm's strategies are for retirement planning and how it might be able to be implemented in your own planning today. Now, this shows a table of contents of what we're going to be going over. The first thing is my firm's rules to investing. We got 3 of them that we like to follow. The next is, our stocks overvalued today? Can bonds actually protect our portfolio? What income strategies in retirement legitimately work? And what are some alternative solutions that we can use for our retirement? Now, the first thing is the rules of investing. And we follow 3 rules here at Costanzo Financial Advisors. The first one is safety first. Now, with safety first, what that means is we want to make sure we protect a portion of our money that is meant for our basic living expenses. I'm not saying the whole portfolio be protected, but with what you want to live on, you want to make sure it's there when you retire. The next is get a reasonable rate of return. I've met so many people who want 20, 30% a year, and they also want full protection from the market. Unfortunately, it does not exist. But what does exist are good investments that can get you that 5, 8% a year, keep up with inflation, while also having some protection as well. And the last thing is keeping it simple. I want all my clients to know exactly what they're getting into when it comes to investments, and they have a full understanding of the strategy that we're implementing. So keeping it simple. And I find by following these 3 rules, we end up having a much more successful retirement and a happier retirement for my clients. Now, the first question that we want to answer are stocks overvalued today? And PE ratio is a great way of looking at that. Now, a PE ratio, it's price to earnings ratio. And basically what they do is they divide the price of the stock versus what that company is earning, and that gives you that PE ratio. Now, an example I like to give is, imagine you have a friend who owns an ice cream truck business, and that truck, he makes $100,000 a year. And that friend says, hey, you want to buy it from me? I'll give it to you for $500,000. It's $100,000, right? 500,000 divided by 100,000, that's 5. That's a price to earnings ratio of 5. Now, it's not a bad deal. You'll make your money back in 5 years, and it's all profit from there. Now, if that same friend came to you and said, hey, I'll give you my ice cream truck for $3 million, well, it'll take you 30 years to make your money back. You're probably not as likely to take that kind of deal. And that's where stocks are today. If you look here on the far left, we have stocks that are cheap. It's an 8 or lower PE ratio. They typically do really well the next 10 years, an average of 10.7% per year. Currently, stocks are at 37.3 PE ratio, which means the ice cream truck that makes $100,000 is selling for 3.7 million. It's expensive. And typically, when anything is above a 33, or average is 33, the next 10-year return is negative 4.6%. Off this chart, you could say stocks are overvalued today based on historical figures that we're looking at with PE ratios. Another thing to look at is the Dow Jones. I'm showing this here today so you can see how markets go up and down, and it's never always going up in the future. So you see we have 2 different colors here, the bull market and the bear market. Now, a bull market means the market's going up. A bear market means the market is going down. You'll see the last 10 years that we were in a bull market. Markets were going up. What normally follows a bull market is a bear market, where things stay stagnant, they don't grow. The last one we had lasted 11 years. We went 0.7% over that 11-year time period in 2000 to 2010. That was the shortest bear market we've ever had in the last 120 years. This chart's showing the Dow Jones. It's a combination of 30 bigger companies in the US market. Now, if we go further back, this is the Great Depression, lasted 25 years. So when it comes to these bear markets, and it looks like we may be approaching one today, we have to be ready for maybe not having great returns for the next 5-10 years. Which means if we need growth in our portfolio, we might not get it in the stock market. So having a strategy outside of stocks that can give us some good returns, I say is a necessity today, and something you should definitely be looking at going forward. The other question that I get asked a lot is, can bonds actually protect our portfolio? Typically, you invest in bonds to diversify from stocks. That has not been the case over the last couple of years here. A large part of that is the rising interest rate environment that we find ourselves in. As rates go up, these bond prices go down. Bonds have lost 5, 10, 15% so far here in 2022. So as that happens, that conservative part of our portfolio is losing money. Now, a common objection to that are bonds earn interest rates. They earn rates every year, called a yield. Now, yields back in the 80s were great, 12% a year. We love those numbers. Unfortunately, we're all the way down here, where you'll see it 0.68% is the yield at the end of 2020. It's a little bit higher today in 2022. Now it's closer to 1-2%. So these yields are barely beating inflation, and we're losing our principal with these bonds as rates go up. So bonds today typically is used as safe money. Put your money there and it's not going to go down. That's just not the case today. And if you're retiring here in the next couple of years, definitely a cause of concern if most of your money is in the bond market. Another question that we always look at is when it comes to retirement income, what are the best strategies that we can make that work? And one thing to go over here is something called the sequence of returns. A common mistake I see people make when it comes to income and retirement is they don't think of what the market may do to affect that income. Now, this is 3 portfolios that we're showing here. All of them earn the same average return over 5 years. So the end of 5 years, they all end up in the same spot. Now they have a different sequence to how they get there. So portfolio A has a great first 3 years and a bad next 2. Portfolio B is 7% across the board. And portfolio C, you lose money the first 2, then you earn it back the next 30. Now, when you're not retired, it doesn't matter so much on the sequence of the returns you get. It's just the average over that time period. When you retire and you start withdrawing money out of your account, the sequence matters a lot. And you can see in this graph that I'm showing here, $1 million in the market. Now, if we're taking $60,000 out a year with a 3% inflation rate, so going up by 3% every year, portfolio A, we don't run out of money. We actually have 1.1 million when we're 90. Portfolio B, we're down to 400,000. In portfolio C, we actually ran out of money around 87. They all did 7% a year. The difference was portfolio C, you lost money those first 2 years as you were drawing money out of your account. And what happened there is you weren't able to recover because you were taking money out of the account. So in these good years, you had less money growing for you and you couldn't quite recover. And every year that became a downward slide towards zero. This is something we want to avoid throughout retirement. And there are strategies that we can use to help prevent this from happening. Which kind of comes to the question of, well, what are some alternative solutions that we can utilize? Now, there are a couple. I'm going to go over one today that a lot of clients typically might use when they want to be conservative and they're close to retirement. This is something called a fixed index annuity. There's a lot of these out here. So I'm going to show an example of what this does. Now I'm showing a chart from 1999 all the way to 2020. And in this, you'll see we start with 100 grand. The S&P 500 is the red line that immediately plunges down 40%, the dot-com bubble. Now that 60 grand ends up recovering and going back up. 2008 happens, and we go right back down. This is that bear market I showed you earlier, the Dow Jones. Now the blue line is an equity index annuity, fixed index annuity, where we stay flat. When the market goes down, we don't lose anything. We stay at 100 grand. Then as markets come back up, we go back up with it. We get 50% of what the market does. So if the S&P does 10%, you would get 5. So you see this market continues to go up, we go up with it, goes down, we stay flat. Comes back up again, we're going back up with it, goes down, we stay flat, and so on. And this is one strategy that we can use to better protect our money. And there are other things, variations that we can do with this, but it kind of gives you a taste of what else is out there besides stocks and bonds that could be a good way to diversify your portfolio and give yourself an edge when it comes to retirement. So overall, when it comes to financial planning, the takeaways from this video I want you to bring home. The first thing, the 3 rules that my firm goes by: keep it safe, get a reasonable rate of return, and keep it simple. By following those rules, I think that puts us above almost every firm out there when it comes to financial planning, because most people don't follow that first one to keep it safe. Now, I've seen many clients lose it all before retirement when they don't need to. The second thing are stocks and bonds today. There are times to be in them and times to not. And your whole portfolio probably shouldn't be in one or the other. It's about diversifying your assets and putting yourself in a position so you know you're going to be able to retire. And lastly, having an income strategy, having strategies around investments that can protect you, but also give you good rates of return, I think are necessary when it comes to retiring today. And that's something that my firm helps with. I'd love to meet with you one-on-one. We can get a 30-minute meeting scheduled, or we can really dive deep into what you have going on today and see how we can help you. Now, I hope you enjoyed the video and have a great rest of your day.